I'm Todd Rosenbluth, Head of Research at VettaFi, and I'm excited to be joined by Joanna Gallegos of BondBloxx here in our New York studio for VettaFi. Thanks for joining us.
Thanks for having me.
It's my pleasure. So BondBloxx has been around a relatively short history of time. Tell us about the overall firm and the overall product lineup.
Sure. So BondBloxx is the only ETF issuer that's 100% focused on fixed income ETFs. And we're a group of industry veterans that realized there was a meaningful, significant gap between fixed income investors' needs and the product offering that existed in ETFs. And so we came together to close that gap. And what we do is we spend a lot of time with many different types of investors, learning about their fixed income uses and what's missing. And then we go build, design, and launch brand new innovative fixed income funds to meet those needs.
So let's talk about what that is. We obviously have an interesting fixed income environment. The Fed might pause interest rates maybe before people end up watching this. But what are you seeing from investors, advisors in particular, in their sentiment?
Yeah, so I think what everybody has been saying in 2023 is bonds are back, but we really have to think about that in context of where are they back from. So they're back from near zero U.S. Treasury interest rates. And the Fed's raised rates now 10 times over 500 basis points. And what that tells you is, and what we focus on is it's not just that bonds are back, but the income is back in fixed income. So we're now in a much higher yielding environment, and we see that there's still a lot of resiliency in corporate fundamentals. And so what we're encouraging and talking to clients about, we really feel that investors should be increasing their allocations to fixed income this year to take advantage of this change in the structural shift in fixed income.
So within the Treasury marketplace, where are you seeing some of that interest?
Yeah, so I think it's across the board, and more recently there's been some interesting developments further out on the curve. But of course, in the last 6 to 8 months, investors have been really seeking out the shorter end of the Treasury curve for two things. One is for safety, as we're sort of maybe you're going to hang out in the shorter end of the curve with these yields. You can't really ignore yields over 4%, or for cash management. And so we've seen a lot of activity, and it's a really good idea to use products that we have like XHLF and X1. Their target duration, their 6 month, and then their 1 year exposures and duration. You can't ignore like low price volatility, low cost, and also this is my favorite feature to mention that I think just hasn't come to people's attention in a long time. But Treasury income is actually state tax exempt, so they're incredibly tax efficient. And we kind of forget, if you invest directly in a Treasury or a fund that holds Treasuries, that is more tax efficient.
I didn't know that.
It's something that we probably all knew and had in the back of our minds, but it's very meaningful. You're holding on to more and more of this yield in this higher yielding environment, and that's significant. The other trade we're starting to see, especially after the first quarter and as we're nearing towards the end of the second half of 2023, is we're seeing clients go further out on the curve for two reasons. One, they're seeking out better returns a little further out on the curve. So we've seen activity in our X2 product, our 3-year target duration product, and even the 5 and 7 year. And then some investors are keeping their portfolios the same, but they're putting a touch more of duration and even going and adding X10 or X20, because those exposures are going to do really well if there is a significant economic downturn. So the Treasury use case has been really powerful for fixed income investors and investors overall in 2023, but we wouldn't stop there. Given this yield environment, we think people should be considering even more.
So let's talk about what even more is. There's high yield products that BondBloxx offers also, right?
Yes, so we actually have a offering across, again, on the very short end of the curve in U.S. Treasuries in 6 months, all the way out to a 14% yielding CCC product in high yield and emerging markets. So our view is that you don't want to shy away from corporate credit right now. You should actually opportunistically think about investing in high yield. And the reason is, going back to that income is back in fixed income, is that yields compared to the beginning of 2022 are almost double across all categories in fixed income. So there's a lot of cushion for your portfolio that you get to start out with at entry points like today. If the economy does go into a downturn and there is more price volatility in credit, even further out in credit, and that cushion in high yield is incredibly helpful on a total return basis. So we see that there's still, even if in our view the credit spread in high yield might extend another 200 basis points, there's still, with the cushion of that income, an ability and a way to see positive returns for 2023. So you don't want to ignore the category of credit or even in high yield, because this high yield environment is really helping your portfolio in a way that it hasn't in 10 or 15 years.
Yeah, this is a completely different environment, and so it's exciting what you and the team at BondBloxx has for the marketplace. So thanks for joining me in the New York studio at VettaFi's offices.
Thank you.
Thanks everybody for tuning in to ETF360. We'll see you next time.